The United States no longer holds a perfect credit rating. This financial blow arrives at the exact moment Washington is gripped by political gridlock, and major transportation infrastructure grinds to a halt. These simultaneous breakdowns signal that America's financial and operational stability is now under immediate, compounding strain. On May 16, 2026, Moody's officially downgraded U.S. credit from AAA to AA1. Moody's was the last major agency holding out. Standard & Poor's stripped the U.S. of its perfect rating in 2011, followed by Fitch in 2023. This chart projects the trajectory of unchecked federal deficits. U.S. debt is scheduled to hit 134% of GDP by 2035. Looking at these future obligations, interest payments on that debt alone will consume 30 cents of every federal dollar within a decade. Treasury Secretary Bessent dismissed the downgrade as a lagging indicator, but the market reaction was immediate. The 10-year Treasury yield spiked to 4.56%. These rising borrowing costs signal deep global concern over Washington's fiscal management. This fiscal crisis is being actively enforced by the political landscape in Washington. In Louisiana, Senator Bill Cassidy lost his Republican primary to Trump-aligned candidates. The defeat is direct retaliation for his 2021 vote to impeach the president. This result signals a narrowing path for bipartisan compromise, as the political cost for lawmakers who cross party lines continues to rise. The immediate casualty is the budget reconciliation bill. The Senate parliamentarian just rejected $1 billion in proposed spending tied to White House upgrades. This ruling complicates the GOP's legislative timeline and points toward firmer fiscal gridlock as lawmakers race against a strict July 4th deadline. Institutional friction is now resulting in compounding domestic infrastructure failures. Contract talks over wages have broken down for the Long Island Railroad, causing a massive strike that has paralyzed regional transit. With 330,000 daily commuters stranded without service, highways are gridlocked, and the local economic workforce is severely disrupted. The risk radar is simultaneously expanding to global flashpoints. In Gaza, an Israeli strike successfully targeted key Hamas planner al-Din al-Haddad. Meanwhile, health officials and the CDC are monitoring a new Ebola outbreak in the Democratic Republic of the Congo that has already claimed 65 lives. These simultaneous local transportation failures and international flashpoints create immediate compounding crises for economic supply chains and global travel. Higher borrowing costs, a politically rigid Congress, and localized infrastructure failures are now converging. Consumer and corporate planning must explicitly account for sustained institutional friction carrying through the third quarter. The immediate primary indicator to watch is whether Washington can maneuver its reconciliation bill past the July 4th deadline.